Hi, this is Bethany from Florida. Thank you for all that you've done to help us become informed investors. I was wondering, last year I invested in a real estate fund, and I'm trying to understand how to compare returns from that fund to my stock and bond returns. It's projected to be a 5 to 7 year investment, so I assume the early returns will be low and then increase as properties are sold. But how do you calculate returns on your real estate investments? And can you only fairly assess their performance after the fund has closed? Thank you.
All right, great question, Bethany. Remember that closing the fund is usually at the beginning of its 5 to 7 year life. Liquidation's at the end. So you really can't compare the return at closing because you're just starting with the investment at closing. So keep that in mind. But the question is, how do you calculate return? Well, the way I calculate return is to calculate a dollar-weighted return. And I do that with a calculation called XIRR. And you can do that in any financial calculator or any spreadsheet. If you go to Excel or Google Sheets, it has this function as part of the spreadsheet. And that's where I calculate my return. All you have to know to calculate your return is the inputs, meaning the money you put into the investment, any money that you put in later, or any money that you took out of the investment, like a dividend or interest it paid or whatever, return of principal, and the dates of those cash flows. Once you know all that, you can calculate an annualized return. You can make a few other adjustments to the sheet in order to get a return for a given year. You can change the dates, etc. I have a tutorial on that on the website. If you just go to whitecoatinvestor.com and search XIRR, it'll pop right up. There's a little sample spreadsheet there, and they'll walk you right through the process. So that's what I use to calculate my return. What I've noticed, however, is that many of these real estate investments give you a return that isn't quite accurate, and it's almost always better than what I calculated to be on XIRR. And that might be just because I only calculate the money as it leaves my bank account and comes back to my bank account. They might be using other dates to calculate it to make it look a little bit better, like the dates they got the money. But that really doesn't matter to me. All I care about is my return in and out of my account. And so I think that's the best way to do it. So I'd encourage you to learn to use that. But your broader question, you're trying to compare, this real estate fund to your stock and bond return. Well, in 2020, your stocks did awesome. So did your bonds, right? So I'm pretty sure your real estate looked really bad. It looked particularly bad because most of these properties in a private syndication or a private fund are not revalued every day like the stock market is. They're probably not even revalued every year. And so you really don't know what that property or that investment is worth. For example, I've had a syndication now for 3 or 4 years. I think it was a $100,000 investment. And if you go onto their website, it still tells you it's worth $100,000. It certainly is not worth $100,000. Might be worth less, might be worth more, but it's not an even 100,000. I can guarantee you that. And so really, you can't tell what your return is until the investment has gone round trip, right? And in a 5 to 7 year equity real estate investment, you're stuck anyway. So who really cares what the return is? It's not like you're getting out early or something, but you really can't fairly calculate it until the end. For example, I have a real estate fund. For the first year, you put money in with capital calls. Actually, it was about 2 years. I think we were putting money in with capital calls. Shortly after those capital calls ended, we started getting principal back. So I think the fund has sold 2 or 3 properties already, and I've gotten the principal back from those properties. And so if I go on the website, this one actually does relatively frequently mark things to market. And so I've still got more than my initial investment in there, but I've gotten some of my principal back, and then I've gotten some income distributions as well. And so it's a little bit unfair to compare that to the return of something that's marked to market every day. Now, I can do it. I plug the numbers into XIRR, and I can tell exactly what my return has been. In fact, if I pull that up here, that is an interesting fund to look at just because we're in the middle of it. I've started getting some of my principal back and so on and so forth. And so let's pull that one up and let's see what my return actually is on this investment. As of today, anyway. So thumb across my investment spreadsheet with a bunch of XIRR calculations for each investment. It tells me that my return on this particular investment is an annualized return of 9.21%. And that's over a period of 4 years so far. But this investment, like yours, has another 3 or 4 years to run. And in the end, it wouldn't surprise me a bit if that return is significantly higher than that. I actually expect it to be higher than that, perhaps in the 15% range. That's partly a result of the fact that leverage is being used in the investment, and part of the fact that I'm probably being paid a premium for being willing to be illiquid for so many years. But that's kind of where we're at right now. If I would have looked at that a couple of years ago, it might have said 2%. And so obviously that would have looked really bad. Some of my other investments, like here's one that is only 3.16%. And that's because the value of the property hasn't been changed. So that's just the income that's come from it, about a 3% income that's come off that particular syndication. And so what I generally see when I look at my spreadsheet, when I look at my equity real estate investments, whether they're syndications or private funds, is generally relatively low returns. And then all of a sudden, once it goes round trip, the return gets dramatically higher. For example, there was one down the street from me for a while. See if I can find it here on my spreadsheet. And it was an equity investment. I think it was might have been preferred equity, but basically there it is right there. I think it was giving me returns of 4% or so. And then when it finally went round trip, it was 13.66%. And so, that I wouldn't necessarily feel too badly that your returns are low. It's generally the case in the beginning with these longer term real estate investments. Obviously, if it's not performing according to the pro forma, that's really what you can compare it to. That was their projections. You can look at those and see how they're doing on those. It'll give you a hint of whether you're on track to meet the projected returns or not. And that's probably more interesting and more useful to you, is simply comparing the distributions and value as it's updated to the pro forma than actually calculating your return and comparing it to stocks and bonds or even publicly traded REITs. Hope that's helpful to you, Bethany. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dahle, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.